The most surprising data point of 2026 isn't the total investment, it's the return. Mid-sized companies are reporting an average ROI of 35% after implementing agentic systems into their supply chains and trading desks. This isn't just a marginal gain. For a mid-sized firm, a 35% return on investment is transformative. It's the difference between struggling for market share and dominating an entire sector through sheer operational efficiency. By automating complex trades and real-time supply chain adjustments, these companies are eliminating the human lag that has plagued global commerce for decades. The agents are simply faster and more precise.
But there is a darker side to this efficiency. To provide the compute power necessary for these agents, big tech companies have taken on a staggering $108 billion in debt for data center expansion. This is the infrastructure debt trap. While the software is delivering high returns for the users, the providers are burning through cash to build the physical world required to run it. The economic tension is palpable. Every major cloud provider is now in a race to build the most efficient agentic backbone, but the cost of entry is rising every day. We are looking at a capital expenditure war that has no clear end in sight.
The tension lies in the mismatch between short-term debt and long-term utility. Big tech is betting that the 35% ROI seen by mid-sized firms will eventually scale to the entire economy, justifying the $108 billion investment. If that bet fails, the fallout could be catastrophic for the tech sector. But if it succeeds, we are looking at the most significant productivity shift in human history. The stakes are truly binary. To maintain this growth, these agents must move beyond simple logistics. They are now being tasked with managing entire financial portfolios, making decisions that used to require a team of analysts.
The efficiency gains in trading are particularly notable. Agentic systems can scan millions of data points across global markets and execute complex hedging strategies in milliseconds, far outperforming traditional algorithmic trading. This has created a winner-take-all dynamic in the mid-market. Companies that adopt these agents early are seeing their margins expand, while those that wait are being squeezed by the sheer speed of the new market. But as more companies adopt these systems, the competitive advantage begins to erode. The 35% ROI might be a temporary window before the entire market adjusts to the new baseline of efficiency. This brings us to the core contradiction of the 2026 AI economy. We have massive capital inflows and high user ROI, but the infrastructure costs are threatening to overwhelm the providers. It is a high wire act where every player is moving at full speed. The question is, who is actually making money in this environment? The answer is more exclusive than you might think. In our final module, we reveal the 5% filter, the brutal reality of AI startup revenue and what it means for the future of this $192 billion shift. Despite the billions in venture capital and the high ROI for users, the startup landscape is surprisingly brutal. Currently, only 5% of AI startups are reaching the revenue targets. The rest are burning through cash with no path to profitability. This 5% filter is the great weeding out process of 2026. The market is no longer rewarding cool tech, it is only rewarding revenue. If you can't prove a direct line to the bottom line, the funding is drying up. This creates a massive divide. On one side, you have the elite 5% who are capturing the lion's share of the $192.7 billion. On the other, you have a sea of zombie startups that are essentially dead companies walking. The reason for this failure rate is the utility gap. Many startups built impressive agents that simply didn't solve a large enough problem to justify their cost. In a world of $108 billion infrastructure debt, nice-to-have software is a death sentence. The startups that are succeeding are those deeply embedded in the supply chain and financial sectors we discussed. They aren't just AI companies, they are logistics and finance companies that happen to use autonomous agents. This specialization is the key to surviving the filter. By focusing on high-value, high-complexity tasks, these companies make themselves indispensable to their clients, ensuring a steady stream of revenue.
For investors, the 5% filter is a warning. The era of spray and pray investing in AI is over. The smart money is now performing deep due diligence on actual usage metrics rather than just model performance. We are seeing a flight to quality. The $192.7 billion is increasingly concentrated in a handful of winners, creating a power law distribution that is even more extreme than previous tech cycles. This concentration of wealth and power has massive implications for the future of the industry. If only a few companies control the agentic backbone of the economy, the barrier to entry for new players becomes almost insurmountable.
So where does this leave us? We have a world where autonomous agents are delivering massive ROI for those who can afford them, while the providers are drowning in infrastructure debt and 95% of startups are failing. It is a landscape of extreme contrast. It is both the most productive era in history and one of the most financially precarious for the companies building the foundation. The tension is the story. The winners of this era won't be the ones with the best models, but the ones with the most sustainable business models. In the end, the $192.7 billion shift is a move toward economic reality.
The shift toward agentic AI in 2026 is more than just a capital rotation. It is the moment AI became a real business. The 35% ROI for mid-sized companies proves the value is there, even if the $108 billion debt suggests the cost is high. As we move forward, the 5% filter will continue to separate the builders from the dreamers. The question is no longer if AI will change the economy, but who will survive the transition to the agentic era. In an economy driven by autonomous agents, the most valuable asset isn't the code, it's the revenue. Will the $108 billion infrastructure gamble pay off, or are we building a foundation of debt for a 5% success rate?